Somewhere between now and the next few years, your family is going to file a long-term care insurance claim. Not maybe. If the policy exists, the claim is coming. And the question is not whether your loved one will need care, the question is whether the policy you have been paying premiums on for 10, 15, or 20 years will actually pay when that moment arrives. Because the companies that sold those policies made a series of financial assumptions about longevity, interest rates, and how often claims would be filed, and nearly every one of those assumptions was wrong. The families now holding those policies are paying for that mistake through rate increases that in some documented cases reached 97% in a single year, and most of them have never looked up the 4 numbers that tell you whether your specific policy from your specific insurer is still a viable financial instrument or a liability dressed up as a safety net. There are 4 numbers. Each one is free to find, and by the end of this video, you will know exactly where to locate each of them and what the number you find should tell you about whether your insurer will still be standing when you need it, and whether your policy will actually trigger benefits when your loved one qualifies. The first number is your insurer's complaint index, and you can find it right now without a subscription, without a broker, and without picking up the phone. The National Association of Insurance Commissioners, headquartered in Kansas City, Missouri, maintains a publicly searchable tool called the Consumer Insurance Search Tool. The industry median complaint index is 1.0. Every insurer with a ratio above that is receiving more complaints per dollar of premium than the median company in the country. An insurer with a complaint index of 3.5 for long-term care specifically is receiving 3.5 times more complaints than the median for the exact line of business you are about to file a claim on. The database separates long-term care complaints from auto, homeowners, and other lines, so you are not looking at a blended number. You are looking at how that company handles long-term care claimants specifically. Here is what that number actually tells you when you look at it carefully. It is not just a measure of customer dissatisfaction. It is a leading indicator of claim behavior. A complaint ratio elevated specifically in long-term care at an insurer that has also filed for multiple rate increases means 2 things are happening at the same time. That is not a coincidence. That is a business model. The second number is your insurer's AM Best financial strength rating, and it measures something different from the complaint index. It measures whether the company will exist to pay the claim at all. AM Best, based in Oldwick, New Jersey, rates insurance company financial strength from A++ at the top down through D at the bottom. For long-term care insurers, a rating below B+ warrants immediate scrutiny. But the rating itself is only part of what you need to see. The trend matters as much as the current number. Genworth Financial, based in Richmond, Virginia, once held investment-grade ratings from multiple agencies and sold more long-term care policies than almost any other company in the country. Genworth has been downgraded repeatedly since 2012. In 2022, Genworth policyholders in multiple states were approved for single-year premium increases of 97%. By 2025, the standalone long-term care insurance market had contracted from more than 100 companies to fewer than 15, with some industry counts putting the number of carriers actively issuing traditional standalone policies as low as 6. Fewer than 15 companies are issuing standalone policies out of the more than 100 that were doing so in 2002. An insurer that has held an A- or better rating for 10 or more years has survived 1 full low interest rate cycle and multiple rounds of reserve revisions. That is a meaningful stability signal. An insurer that has been downgraded multiple times since 2010 is telling you something about its reserve position that its customer service representatives are not. The third number is the count of rate increase approvals your specific policy form has received since it was issued. Not the percentage, the count, and then the percentage, and then the math. Every state insurance commissioner maintains a public record of all approved rate actions by insurer and policy form number. The policy form number is printed on the declarations page of your policy document. You take that number to your state's Department of Insurance website. You search for your insurer's name and policy form, and you count the approved increases. A policy issued in 2000 that has received 8 approved rate increases, averaging 20% per increase, has had its premium multiplied by a factor of approximately 4.3 since the day it was signed. And the SEC filings of the major long-term care insurers confirm that further increases are already in actuarial planning. The rate history does not tell you when the next increase is coming. It tells you whether you are in a stable rate cohort or a problem block, and those two situations require completely different responses. The fourth number is the one most families have never looked for, and it is the one that determines whether any of the other 3 numbers matters at all. It is the ADL count in your policy's benefit trigger language. Under federal tax-qualified long-term care insurance standards, benefits are triggered when a person cannot perform 2 out of 6 activities of daily living, a category that includes bathing, dressing, eating, continence, toileting, and transferring. But some policies, particularly non-tax qualified policies issued before the federal standards were fully adopted, require 3 out of 6. The difference between a 2 ADL trigger and a 3 ADL trigger is not a technicality. It is the difference between a policy that begins paying in the early stages of a cognitive or physical decline and a policy that requires a person to be significantly further into that decline before a single benefit dollar flows. The Nursing Home Reform Act established federal baseline standards, and the NAIC's model regulation provided guidance to states. But adoption was uneven, and policies written before full state adoption may contain benefit trigger language that is more restrictive than what families were told to expect. This language is not in the summary page. It is not in the enrollment booklet. It is in the benefits section of the policy document itself. Before we get into why the industry arrived at this place simultaneously across nearly every major carrier, if you have a loved one who currently holds a long-term care policy, subscribing is the simplest way to make sure the next piece of information this channel publishes on this topic reaches you before a claim situation forces you to find it on your own. The deeper you go into how the long-term care insurance market actually collapsed, the more one mechanism becomes impossible to ignore. The companies that sold these policies in the 1990s and 2000s priced them based on assumptions about how long policyholders would live, how often they would file claims, and what interest rates would do to the investment returns backing those reserves. Every one of those assumptions moved in the wrong direction at the same time. People lived longer. They filed claims more frequently and for longer durations than modeled. And interest rates fell to near zero and stayed there for years. The result was a reserve shortfall that stretched across the industry simultaneously, which is why the contraction from more than 100 carriers to fewer than 15 was not a story about a few bad actors. It was a story about an entire industry discovering, at roughly the same time, that the product had been systematically underpriced from the beginning. What this means for families holding policies today is that the insurer's incentive is no longer neutral. An insurer with an underfunded reserve position has a financial interest in rate increases steep enough to cause policyholders to lapse their coverage, in claim processes restrictive enough to reduce paid claims, and in benefit trigger interpretations favorable to the company rather than the policyholder. The named lawsuits and regulatory settlements involving Genworth Financial, Transamerica, and Bankers Life, a subsidiary of CNO Financial headquartered in Chicago, Illinois, are not isolated compliance failures. They document what happens when the financial incentive and the contractual obligation point in opposite directions. Those 4 numbers, taken together, give you a picture of which side of that equation your policy currently sits on. Everything before this point is what your insurer would prefer you never look up before you reach the claim stage. What follows is what they are genuinely afraid you will do with it. Here is what you found out at the beginning of this video. The 4th number, the ADL count in your benefit trigger language, is the one number that most directly controls whether your policy pays in the early or middle stages of a decline, or not at all. The policy document is where that number lives. Here is how to find all 4. First, look up your insurer's complaint index at the National Association of Insurance Commissioners consumer insurance search tool. It is free and requires no registration. Search by your insurer's name, select long-term care as the line of business, and note the index number relative to the industry median of 1.0. 30 minutes, no cost. This number tells you how your insurer treats claimants before you are one. Second, look up your insurer's AM Best financial strength rating and its rating history at the AM Best website. Basic ratings are available without a subscription. Note the current rating and whether it has changed more than once since 2010. 15 minutes, no cost. This number tells you whether the company will exist to pay your claim. Third, go to your state's Department of Insurance website and search for your insurer's name and your policy form number. The form number is on the declarations page of your policy. Count the number of approved rate increase requests since your policy was issued and calculate the cumulative premium multiple. 45 minutes, no cost. This number tells you whether you are in a stable cohort or a problem block, and whether a paid-up option should be explored before the next increase arrives. Fourth, pull out your actual policy document and find the section titled Benefits or Benefit Triggers. Count how many ADLs are required before benefits begin. If the number is 3 or more, contact your state health insurance assistance program, which operates through a federally funded network called SHIP, to get a free, independent review of your specific policy language and your options. 30 minutes to read. Free counseling through SHIP. This number determines whether your policy pays early in a decline or requires your loved one to be significantly further along before benefits begin. The complete protocol takes approximately 2 hours and $0. The average annual long-term care insurance premium for a policy purchased in 2000 is now between $3,000 and $7,000 per year. The stakes of not running this review are not theoretical. Before this video, you were the policyholder the long-term care insurance industry was depending on to keep paying premiums, without ever verifying the 4 data points that together determine whether that policy will perform when it matters. You are now the policyholder who knows that those 4 numbers are public, free, and each one is telling you something different about the same underlying question. Drop a comment if this matches what you have been experiencing, because the pattern of what families are going through is part of the story this channel is trying to document. Every video on this channel is built around one principle. Your family deserves to know how this system actually works before you are inside it. Subscribe so the next investigation reaches you in time to use it.